Bascan here with me from Harbour Asset Management, and he did a great presentation this morning on investing in shares for income, and so he's going to talk us through that today. So Andrew, one of the points you started with in your presentation is that we've been in a 30-year bull market for bonds, and that can't go on forever, and people have to start thinking about how they invest again for income. Can you run us through that historical background first?
Yeah. So in 1984, the US bond market was yielding 4 times as much as it is today in real terms, and 6 times as much in nominal terms as it was today. So for 30 years, the US bond has been gradually falling in terms of yield as inflation has fallen. As a result, we're sitting here today, US bonds at 2.5%, and there are signs that maybe that 30-year bull run has come to an end. I don't think necessarily in the next few months or a year necessarily we're going to have a significant backup in bond yields, but it means for income investors globally, the anchor for providing strong yield starts with a very low base. As a result, investors are searching elsewhere for yield.
So one of the places they're looking at is equities now, and you guys run an equity income portfolio. Can you run us through that? And like one of the things you were saying today, it's not actually necessarily about chasing the highest yielding stocks as what you put into your portfolio?
Yeah, so for investors who are looking to diversify out of traditional sources of income, as they move into equities, we don't want them to jump into the highest octane equities, which have the highest volatility. Obviously, we want them to be sensible about looking for, at the margin, companies that are providing a reasonable yield that still have growth available. So take, for example, a portfolio approach that would see an investor move from a diversified portfolio of bonds or corporate bonds into a diversified portfolio of Australasian higher yield stocks. We'd be wanting them to think about stocks that don't have, ritzy 10, 11, 12% yields, but stocks that have the yield in around the 6 to 8%.
So the companies with the highest yielding stocks tended to be the ones which were far more volatile, I think was one of your key points.
So what we've found, looking back over the last 15 years, is that if you just chase the stocks with the highest yield, you end up with 2 things. One, you end up with much higher volatility, but 2, there's no guarantee that that portfolio will actually have the highest returns. In fact, we found that stocks that had yields around about 6 to 8% had both the highest return and actually the lowest risk.
And that's partly because they still had growth in them, so they could keep growing, that you got some capital growth as well?
Yeah.
Is that...
The key thing we found was that stocks that have the highest yield are generally the most risky because they have a higher yield because the market's uncertain about the prospects. Whereas the companies that have a reasonable yield generally have reasonable growth prospects, and over time their dividends can grow.
And you have different buckets of yields, like 6 to 8% and 8 to 10 and 10 to 12. Which buckets were the most attractive to you?
To us, we like to think about building a diversified portfolio with yield being 4% or higher, but we're not looking for companies yielding much more than 8 or 9%. We think that that's the zone of most attractive sourcing of companies. So between 4 to 8%, we think that's a pretty good attractive area.
And so when you put all back into a portfolio, what sort of return would that the equity income portfolio generate in a year?
So currently, as of the middle of May 2014, we're seeing a diversified portfolio of around about 40 stocks across Australia and New Zealand, yielding around about 6.25 to 6.5%.
So that's gross?
That's the gross yield.
Yeah.
In addition, we think these companies are growing those dividends by around about 4 to 5% a year. So over a period of time, you'd expect some capital gain, not significant, but some capital gain to add to that yield.
And the TD market at the moment is pretty inactive. I guess this is a far better option in terms of that sense.
Yeah, it seems to me that banks have almost completed rebuilding their deposit books, and competition for deposits has eased somewhat. So whilst the 2-year swap bond market has risen significantly in the last 6 months in anticipation of higher overnight cash rates, the TD market hasn't followed. So investors looking for traditional sources of yield in term deposits are being pushed out into higher yielding and maybe higher risk securities. So
Sort of
corporate bonds,
like
equity
yes.
income.
Yeah, and we've seen a few of those issues recently, and one in particular was probably quite risky for what the reward was.
Yeah, so our view is that investors shouldn't get sucked into subordinate corporate bonds that aren't strong investment credits with yields that just aren't attractive.
And they don't have the diversification. Yeah.
Yeah, so people building diversified portfolios of yield should be looking at diversified portfolios of at least 30 to 40 bonds, and I would think at least 40 to 50 equity securities. What you find is people who just go and buy 4 or 5 bonds and 4 or 5 securities end up with a whole lot of volatility they didn't expect.
Yeah. Lots of good things to think about there, and I know today in terms of people listening to the presentation, it certainly made them think about the topic in more detail too. So thank you very much for your time.
Thanks.